Um, my name is Nic Chahine. I'm with Marketfy.com. I run a couple of services there. Most exciting is the credit spreads, and it's a create income with credit spreads. We'll get that to you later. Here today, before I get started, actually, Morgan's been doing a great job with this team. Outstanding turnout worldwide. That's amazing. I love seeing those maps. And obviously, the charity work comes first. I wish more people would do charity work. I think the world will be much better. Before I get started again, I want to apologize ahead of time if I'm a little slow today, if I hit a couple of wrong buttons, because I'm working with one eye. I practice mixed martial arts, and a couple of days ago I had a sparring session that went a little crazy, so I'm sporting a big mouse over my left eye and it's completely closed. So working with one eye today. Let's see here. I'm trying to see if most of you are hooked up. It looks like it. A couple of you are having a little issues with the slides, but I think we can go on here. All right. Today we're going to do a quick recap as far as options are concerned. Not going to be too complicated. I love keeping it as straightforward as possible. I'm seeing a little more people with no slides, so I'm trying to delay here until they get back on, but they can hear me. The slides are not as important as what I'm telling you. Hopefully they can get started in a few minutes. The terminology, we're going to go through a few key terms in options world that may be a little different or may make you a little hesitant to delving into options. You know, when I first was trading stocks eons ago, the one thing that was, on everybody's mind, oh my God, options are so crazy, they're so dangerous. And yeah, true. They can be dangerous, they can be crazy, but same with any investment, especially on stocks. I remember a few companies like Webvan. If you don't remember it, that's the point. They come and go. More recently, AIG, GM, everybody almost went out of business. So stocks are dangerous, options are dangerous. You use either without caution, you can lose a ton of money either way. So it's how you use it. So okay, we've got options. What are they? Most of you have heard puts and calls. And sorry if some of you already know all of this stuff. I was just going to go recap quickly so everybody will be on the same page. We got puts and calls, and we'll show you which is which, bearish, bullish. Some terminology is an option what is it? Margins, short, long, strike, expiry, contracts. We're going to go through some strategies, how to buy puts and calls, and we're going to compare a couple scenarios as far as stocks versus options. Some other strategies, which is pretty exciting, synthetic dividends. It's a fancy word for saying basically create your own dividends. That always gets people's attention. You can protect the position. This is May, right? And we're supposed to be selling off, right? Not happening, but if you think that sell-off is coming, you can do that. And as far as short positions, shorting stocks, very dangerous. You can do it safely using options. Some earnings play. I have a few ideas on earnings, a few opinions, I should say, not very popular, that earnings plays are no better than a coin toss. It is definitely no better than a coin toss, and I'd like to debate that too. How can you do spreads also? They come in two flavors. And most importantly is that all the traders that I know use options, and they're good traders. They get to be great traders if they use options along with whatever other strategies that they have. So, and before I move on to other slides, one thing we won't do here is talk Greek. Options have a lot of fancy talk to them. If you get the basics, you get started, then you can start studying the Greeks if you'd like to understand more of the what makes them move price-wise here or there. So moving on here, we've got the, okay, what are options? I mentioned we're going to cover terms. These are not the same as company stock options that you get from an employer as part of your compensations. These are contracts. And they usually have an expiration date. So if you enter into a contract. They come in weekly versions. They come in quarterly, monthly. Even you can get to leap, so you can go further out in time. So basically, you're entering into a contract, and each contract is for 100 shares. So whenever you do buy an option, whether put or call, you're basically taking out a contract that has a lifespan, and it expires on a certain date. And then it gives you options, it gives you rights, or it obligates you, depends on how you take the position, into doing something during that period of time. Yeah, I know some people have bad time with options, but if you get educated on it, you can probably get a little better at it. Now, margin is a little different than borrowing. That's funny. Margin is definitely not the same as the margin when you go to borrow to buy stocks. Here, margin is if I had 10,000 in my account, and then I take a position that creates a $5,000 risk, maximum risk, should everything go to heck, then that portion of my account is locked out, and it's called a margin requirement. And the online trading platform will reserve 5 of the 10 will be, I can't access it because I have risk against it, and they cash back it up. And what's a leg? If I buy an option, that's a leg. If I buy and sell an option, I've got 2 legs. Yeah, bull put spreads I love too, Gene. And then puts and calls, what happens with the puts? If I am bearish on the stock, I think it's going to go down, I buy puts. That's very simply stated. If I'm bullish on the stock and I think it's going to the moon, I buy calls. And the spreads are basically a combination of 2 puts or 2 calls. It depends on, different time zones, all kinds of flavors. I have 2 favorites. My favorite, I just saw somebody streak it through, is the credit put spread, which is a bullish strategy. They are complex. This is just an intro. If you haven't seen them before, if you've seen them before, then this is just, you're going to pick up a thing or 2 here. So moving on. This is what an option chain looks like. Now, this just happens to be Apple, and it is, let me see here, April, so a little past as far as time is concerned. But here are the puts, and here are the calls. That little difference in color here shows you where the price is. So price at the time here was somewhere around here, and which is around 455-ish, 457, whatever it is. So anything down here is a put that I would buy if I think the stock is going down. So if I do buy this right here at 445, that means right there, that means I expect the stock to go down towards it. Doesn't have to hit it. I'm just going down towards it. So if I invest into that assets and I pay the $10 that this contract demands, then I expected that it's going to sell off towards that strike, and within a short period of time, and depends on how far out you go in time, and then that asset gets more expensive. So I bought something for 10 bucks. It's getting more expensive. I'm making money because now I can sell it for that more expensive price. And conversely, I could have done the same, the opposite way. If I was bullish, then I could buy this one right here for $11.20. And if the stock goes up, guess what? I'm in the money because that $11 is going to be more expensive. If you go up here, you can see how they get more expensive as they get in the money. And same here. So if somebody made a bet here, they made a ton of money. So these are just purchasing naked. So I am buying one way or another. So this is just a typical put call strategy. Now it can get more complicated, and we'll get to it in a little bit. So which is better, options or straight stocks? Now this is where the battle is going to ensue. Earning plays. Let's revisit. I mentioned something about earning plays being toss-ups. I can do all the research in the world and say, okay, Netflix is going to hit their numbers or miss their numbers, and I'm convinced because this or that. It doesn't matter. They're going to come out with their numbers, and the market is going to react. And that's the one thing that we can't bet on. How is the market going to react? Yeah, they hit their numbers, but then the market will say, well, they hit their numbers by doing blah and blah, the tax benefits, and they sold assets, and you know, they discounted, they have a lot of inventory. So it's the reaction, the market reaction is what really, really counts. I can do the homework. I can't bet on the market reaction, so it's a coin toss. Might as well go to Vegas and have more fun with it. So, but you can have some option plays that help you bank on the earnings with a lot less risk. So this is a real-life example from Netflix, which reported recently. I believe it was in April. And just before the report, the night before the report, I bought a call. And here's what happened. And this is what it looked like at the close right here, okay? Netflix 175-ish, 174-ish. And then I decided to buy this call right here, which was close to the money, the 175. I paid $13.15 for it. So since we said that it was 100 contracts, so you multiply that by 100, and that's the total cost. That's my total risk. And I can't lose more than what I just paid, $13.15. And then this is just before, at the close. And now, after the close, they reported, and look at that price here. It just jumped up like you wouldn't believe. So they reported whatever the numbers were. The market obviously loved it. So how did the market react? To the upside. My bet was, yes, I did mean $1,315. Don't know what I said in backwards now. But anyway, so that's my maximum risk. $13.15 as the price of the one unit times 100. The next day at open, this is a snapshot of what happened. It not only went through the after hours prices, but it went higher than that. And that same 175 strike is what now? Almost $42. So going back, I can't back up. Okay, never mind. I paid $13.15. Here it's $42. So subtract one from the other, that's how much money I made. Multiply by 100 is really the money I made. So this was, there we go, $13.15. The next day at open was $42. That's pretty hefty profit. So which is better, options or stocks? In stocks, let's say I wanted to do the same thing. I could have bought 100 shares because I did one contract, so that's 100 shares. 100 shares times $174, that was the price at the close. That's a pretty big chunk of money, and that's my total risk. In theory, it's not going to go to zero. I mean, in reality, it's not going to go to zero. But in theory, yes, it may go to zero. It's happened before, but you know, unlikely. But still, that's my maximum risk. I profited a bucket. Next day, $216. I made $4,200. Yeah, but that's a good hefty return of 24%. Now let's compare. I bought one contract of Netflix, and it cost me $13.15. So again, now my risk is not $17,000; it's $13.15. So that's a huge difference. I sleep better risking $13.15 than 17 grand. I don't know about you. And then the next day, the same contract was $42, so I made $2,800, $2,900. Okay, it's not as big as the $4,200, but guess what? It is 220% almost. So more bang for the buck is what I'm saying. I risked $1,300 to make this much. I'll take this route versus this route any day of the week. So $1,300, you know, it's not a lot of money for big time players, but if you're like me, you may want to risk less than $1,315 and still play the earnings and still get a big return, bigger than 24%. So what could I have done? So let me see if I can back up here. All right. So how do you erase all of this stuff? Trash can. There we go. Okay. Let's say I don't want to invest all of the $13.15. It's still a lot of money. What can I do? I can do a spread, which I'm jumping the gun here, but it's perfect time to put it in. I can buy this $13.15 and sell the leg right above it. It's going to be cheaper. So now the total cost is the difference between $13.15 and $10.8. So I'm paying a couple of bucks here, 240-ish, and I'm taking the same bet. I'm betting that it's going to go up. But I'm not risking $1,300. I'm risking like $230. That's definitely a lotto play, and I can sleep at night better doing that. And my return would have been, the next day it would have been $5, the difference between these two numbers. So I bought something for $230 and now it's worth $500. So I doubled my money with only risking $250. So you see, it's the options can be played. Risky, sure, not any more risky. It's actually a lot riskier than buying the stock outright. My total risk was defined. Yeah, I won't use bet. Bank, is that better? Somebody said don't use bet. So anyway, I'm banking on a profit, but I'm only risking the premium I paid. So my risk is defined. I can sleep better. That's my take on options. Yes, they are risky. Yes, you can take a lot of risk, and it can be infinite. But in this case, it's very well defined. Another example, almost identical, was Apple. I made a trade with Apple. I paid $1,530 or so for a call. Just a few days later, it popped, and then it turned into a $32 profit. I mean, price. So the profit is the difference between the two. Again, the bang for the buck is not even to be compared. I'd like to comment on all of the things that are going through, but boy, they're going through quickly, and it's going to throw me off, and I'm going to sound like an idiot on the presentation. So anyway, but here the profit was doubling my money basically versus a 7% return had I just bought Apple. Sharks. So this was just another recent example, real life example. Nothing I do on our site on Marketfy is paper trades. I take every trade I post, and I also take some trades that I don't put in the portfolio, but I post for them to track me. So these are real life, real examples. So now we all agree that option, well, maybe we don't. I see some tweets here, or not tweets, some notes that not everybody's still convinced of options. They're a good thing, or at least you can admit to yourself that that can be a good thing. If not, I'd love to debate that offline sometimes. You can track me on Twitter, and we'll chat that. I'm Racer Nick on Twitter without a K. If you were, okay, now changing subject a little bit, happier times, dividends. Do we all like dividends? Can I see anybody? Dividends? Come on. Who likes dividends? There we go. Boom, boom. No. Anyway, dividends. 2013, if you were long, you did well. Except if you're in an Apple trade, it's been a tough, painful trade. Special dividend anticipation pretty much killed it. Everybody was ticked off at Mr. Cook. Pay me back, even though he paid them like zillions over time in capital appreciation, but they still wanted to, well, you got too much cash. Who cares? That's my take on it. You got too much cash, they're making me money in the stock price. Who cares? So special dividend killed it. The street was furious with the management, and they even sued it. So instead of suing the company, why not create your own dividends? So you can do that by simply, if you owned, say, so we're not stuck on Apple. If you owned Google, 100 shares, and you're down in it, but you're still bullish, you don't want to sell it, and you want to put them to work, that can be a create your own dividend play, or it can also be a kind of like a putting a losing trade to work play, and even some protection play. You can consider it to limit the downside. So if you own Google, you can play weeklies, or you can play longer dated options, and you can sell calls. This is the call side. These are cover called, yes. You can sell calls against what you own. You own an asset, put it to work. Why not put it to work? That's crazy. So you can sell short-term weeklies and repeat every week, or you can sell longer-term monthlies, or even go out to a quarter, or go out to a year, to leaps. So in this case, wherever Google was, you can go out a few strikes out, and if you think in this next week Google is not, from that period of time, is not going to hit this level, what you do is you sell that call, and it's called you're selling against your own stock, so there's no extra risk. So there's no margin requirement against it. Your only risk is that they're going to force you, you're going to be called away from your position. So if Google runs through this and you are at expiration date and it's above the price, then you're called away from your stock. So what's the worst case scenario is you get to participate in the upside, and then you get to keep the premium, but you lost the stock. You can always rebuy it. So the risk is not to the downside, the risk is losing your position in Google. If you don't want to risk it, then go out higher. Go to $20 higher than that. Longer in time, but if you sell the covered call, Google needs to go up higher, so you're participating in more upside, and then you get called away, and then you get to keep the $2 times 100 that you collect. So here you collect 100 a week. Here you're collecting 200 and some change, 2 weeks or whatever, a period of time, 20 days. I can't read this small, one-eyed again. So these are covered calls. You're selling covered calls. You're putting your asset to work. This can be to create your own dividend. You can do this every week. You can do this every month or every quarter. You can consider this as downside protection. Because that premium will protect you $100 on the downside. So, it's little chump change, but in theory it is. You can, if this is a losing trade, if you were in Apple and you're down $100 and you haven't sold, too late to sell. Wow, Kuala Lumpur, nice, Malaysia. If it's too late to sell, then why not put your Apple stock to work and start selling calls? And then pretty much now, if you entered it at 700 and you collected hundreds of dollars along the way, now your entry point is not really 700. Now it's down to 650. So you only need Apple to go up to 650. Boy, that's a sad statement. But anyway, you get my point. So you're actually putting your asset to work while you wait for it to recover. That is, I wouldn't do this with Webvan or Peapod. I would do this with Apple or Google or any of GE or IBM or companies that I know they're well managed, proven history, and most likely are going to be here down the line. Because you can't do this or average down as people do on a losing bet or on a iffy stock or an unproven theory like LinkedIn just went public. Yes, it's a great company, got good reputation, but it's still yet to prove itself. I mean, we can get a note sometime that, oh, LinkedIn has been faked. The count of 1 billion people, not really close to half of that. You get my point. So make sure if you have an asset, make sure it's an asset and not a very risky asset. Okay, moving on. The sell-off is coming. The sell-off is coming. What do? I can sell everything and hide. The sell-off is not going to come. Holy crap, it's been like a rocket ship. 2, you can protect using options, especially if you know that the sell-off is going to come, like the sell in May adage that I hate. Sell in May and go away, but these days it's like buy in April, buy in May, buy in June and July, and forever buy, as long as the feds are in it. So you can protect using options. So first we did create your own dividends, synthetic dividends. Now we can say, okay, we've got some stock protection positions. So what can we do here? Very simply put, if I owned Google and it's about $815 thereabouts, and I'm okay down at 780, I can buy a put at 780, and that caps my losses right here. So if I buy a put, that protects 100 of my shares from below 780. So if stock goes to 0, I don't lose anything past 780. It gives me the right to sell that stock at 780 if it goes below that within the options contract. So whatever, if I took a May, it expires in the middle of May. So if between now and the middle of May, which is next week, Google goes to 0, I'm protected from 780 on down. My losses are from here to here. If there are losses, depends where I entered the contract. But it cost me $495 to do it from that period of time. Let's see if I can erase all of this junk. Okay, because that price of the put was $495. Big money for me. I'm frugal. I don't like paying $495. What can I do? I can reduce my cost. I own the stock. Now, first we saw how we can do a covered call, right? So why not do a covered call to finance the protection? Hey, financing is free. Not only free, I can actually make money. So if I want to protect at 780, I buy this protection, but I also sell this one, a covered call, at 555. So now I'm making money to insure my stock. So I buy the put, sell the call, no margin requirement. I own the stocks. So the selling here is a naked sell if I didn't own the stock. I wouldn't do that, naked sell. I buy the put. Selling puts naked will take a lot of somebody's doing here, TJ. You can sell the put naked, yes, but it takes up a lot of margin and it creates huge risk. We'll get to that a little later. So buy the put, sell the call, you protect for credit. So I can sleep at night, and it didn't cost me anything to do it. And that expires in May. I can do it again for the week after. I can do it again for the month after. I can do it again for a year down the line and just expand, go out as far away from the current price. You get the theory. If you don't get it, just type in. Maybe I can catch your comment and try to clarify it. Now I can do something else as far as protection. It's called a spread. We're getting closer to that credit spread. I can see a lot of credit spread people there. The put spread, this is I want to protect, but not all the way. Okay, I want to protect it at 780, but I don't think it's going to go way too far. So I'm comfortable financing some of that 780 cost by selling a put behind it. You see that? So I buy the 495, I sell the 365, I get myself about $10 worth of protection for a reasonable amount of money. So it doesn't protect me all the way to zero, but it gives me $10 worth of basically protection, and I can sleep better at night. Now I can do something else, and I can combine all three methods by doing the same spread, but why not sell one of these to finance the difference? So I get the $10 worth of protection, yes, minus 130 like we just saw, but why not sell up here for $2? This way I can get a credit. So again, I'm protecting for free. Pretty good concept in my opinion. So you can do protection naked. You can do protection by buying the put and financing by selling a call, covered call, or you can do a protection by buying a put spread, or you can do protection by buying a put spread and selling the call to finance the put spread. So plenty of ways of doing it. I don't like to shut out money out of pocket. I prefer buying a put, selling a call. Simple and very easy to do over and over. If I was nervous about the stock. If I'm not nervous, I can just ride it out. There's more. Here we go. Option spreads. We already mentioned. They come in a couple of flavors that I like. Debit spread and credit spread. Debit spread means I pay to enter the spread, which means that I'm doing like we did earlier. I am here. This is a debit spread. I paid to enter the spread. I bought the more expensive one and I sold the less expensive one. So I'm paying out of my pocket. The credit spread is the exact opposite of that, and that's what we do at Marketfy. It's also a directional bet. If I am bullish Google, I'll sell a credit spread in it below where it is right now, far enough to stay out of trouble. And then hopefully Google doesn't even come close to it and expire worthless, and I make my money for maximum gain. Here it's just like the debit spread, except here we're the premium seller, so we're basically selling the insurance. Why would you do a debit spread? Is if I'm bearish the company and I want to make money on it going down, but I don't want to shut out the $4.95. So I buy the $4.95 and I sell one below it to partly finance that and reduce my outlay. But that also reduces my potential profit to the maximum width of the spread. So if I buy at $5 wide spread, then the maximum I could make is 500 if I did one contract minus the whatever I paid for it. So I can double my money basically, but not have to spend $4.95. Does that make sense? Hopefully it does. I just saw a question come up. Okay, we have a debit spread example. We just saw it. I don't have to, the maximum risk is the money I paid for it. The maximum profit, it's $10 wide, you know, it's 780 to 770. I can make $10 minus what I paid for it. So that is my maximum profit. Had I just paid the 495, my profit will be, woo, you know, as long as Google's going down, I'm making money. Here, I'm capping my profit, but I am actually also only spending 130 versus 495. So I'm more comfortable. I can do it twice. I can do it 3 times, and then my profit will be 3 times the width minus. So I can triple that and still be at the 495 level-ish. So that is a debit spread. Now, moving on to a credit spread, my favorite, this is a real-life example from my kid's account, I think. Yeah, I have an 11-year-old son, and I did a trade at the time, which paid him big time. Took a little more aggressive stance on it, but he's young. He can recover from the mistakes. Okay, here we did a Google bullish play, a credit put spread in Google. And after the earnings, just after the earnings, people loved it, went up. I figured, okay, 750 was safe enough, and guess what? I was right? So I did 20 times. I did 20 contracts, and I collected 48 cents times 20. So that day in his account, $960 went into his account, almost $1,000. Now, did I get your attention? Okay, and it was a fairly low. Google was around $800, so it would have needed to drop $50 for me to be in danger of losing money or getting into money here. So credit spread, I take $1,000. And if Google doesn't even come close to 750, I get to keep all the money within the period of time of that. And that was just a, 20-day bet. Oh, said bet again, 20-day contract. So this contract expired worthless, which is a good thing, because no, he doesn't trade. Although he likes to buy RC companies because he races little RC trucks. So in this case, we collected 960, and it expired worthless, which is basically I get to keep the entire 960, or he gets to keep the entire 960 in his account. Good thing. So this is an example of a credit spread. Here's another example. This is actually a screenshot from our Marketfy.com account. And it looks like I lost money, but I didn't. Remember, these are spreads. And in the Marketfy, they show each leg. Remember, we talked about legs. In a credit spread, we have a long leg and a short leg. The maximum loss on the 20 contract of the spread would be huge. Yes, it would be huge. It's $5 minus the 48 cents times 20 times 100. But it was about 10% lower than current price, Jason. And I had my eye on it all day, every day. If it starts running against me, I can always buy insurance and or adjust the position. I can sprawl it into iron condors. I use weekly credit spreads as well. It all depends on, if I'm going on vacation, I tend to not use weeklies because then you're plastered against the computer. So it depends on what I'm doing in my life. So commissions on 20, it's a big question. It varies tremendously. I use Trade Monster, and they seem to be, I do diagonals, but not as much. They seem to be best balance of price and performance. So anyway, this is another real example. Thanks for the questions, by the way. These are great. I did 10 contracts. This was $10 wide. I don't like to do credit spreads that are $10 wide, but it was safe enough. It was a weekly RUT, which is a small caps. How do you defend the credit or debit spreads? Defending credit spreads, I bet against it the other way, smaller. Can I comment on credit spread losers? Yes. Yes, of course they can wipe out winners. That's why you have to be diligent. And I'll show you, I'll give you an example a little later. So this is another example here. One leg loses, one leg loses, one leg wins, but if you add the two, that's the win for the spread. And this was just a one-day spread. We did it, boop, the small caps pop. I always take a pop. It is limited to this width of the spread. Iron condors, I love them. I'll get to them in a second. Okay, Iron Condor is a credit spread and a credit spread on the put side and a credit spread on the call side. So if you do, you're betting against each other basically. You're taking a long position and then you're taking a short position. So you're basically trying to range it. For example, if I say, okay, next month Apple is going to end up between $500 and $600, then I'll do an iron condor. I'll sell the 500 put, I'll buy the 495 put. I'll sell the 600 call, I'll buy the 605 call. And then I have a, some jokes going through, I have an iron condor. And that is a good hedge because let's say price moves one way or another, then you have time to react because one side of the iron condor gets worse, but the other side benefits. So unless it moves $50 at a time, then you have to, yeah, there are small wins, but if you do them constantly and far away from trouble, then you have less risk of incident and more successful little wins than one big home run. We're not looking for home runs here. And you have to be diligent. You have to put your exit strategies. And if the iron condor starts to get it to the level where you're going to close it, you close it. You got a sign 2 on the short legs. You waited too long to close it. Okay, here's another example. 28 cents. That's not a lot of money, but I did it, and I did it again for 40 cents. And I did it again for 46 cents. And here's some protection. You know, I bought a little protection weeklies that are a lot cheaper. So if the stock jumps big against me, I've got something that's going to buffer and give me some time to react. Here's a big gamble I took on Google. I did a credit call vertical on it. And it was at 860, 865. That was a while back in March. And I did it 3,500 times. A lot of money, but 61 cents, 3,500 times. That's a good chunk of change. It expired worthless, so I kept the whole thing. So this is, credit spreads are great if you do them without breaking your own rules. If you establish good rules, you can stay out of trouble. Now here's a, let's see, this looks like April snapshot. Whoa, what's going on? My pen's stuck. April snapshot from the Marketfy, and you can see here's one. They're all winners, and I can't delete them. So these are all wins, little wins, but you know, $200, $300, $400 a week. That's what I promise. $200, $300, $400 a week. Great. If it's only $100 a week, that's a good raise for anybody. If you want to make it your job, then you better be good at it, and you better do a lot of it. This was protection that I didn't need to use, so it was $47 that I wasted, but I slept better doing it. And this was protection that I got to use, and I guess what? It made me money. What is a good rule of thumb when to liquidate a short spread to avoid assignments? Well, first of all, you can't get assigned unless it's in the money. And if you let it go into the money, then you waited way too long. So stay away, take the pain. You can always reopen it somewhere else. So if you say, okay, I took in 40 cents on this, I'm willing to go where it starts getting into close to $1, and that's it, I'm out. If that spread starts to be $1, take the 60 cents loss and move on, or adjust it, move it lower, so take half the loss to bring it down, and sell something the other side. Sometimes if I take a credit put spread at 850 and Google starts to get to 850, I'll close it, I'll open it at 820, and I'll open a credit call spread against it to offset the cost that it took me to do the move, the reset. Sometimes underlying opens confusing, but yes, good info. Okay, somebody says sometimes underlying opens for the day and the money. Yeah, if you get a big pop, you're in trouble. So you shouldn't be that close to the money anyway. Pick up a couple of dozen stocks that you can trend and play with those, and that's it, or indices. Don't try to get into new stuff. One of my subscribers on Marketfy wanted to look at the 3D company, DDD. And I said, you know, seems like a good company, but it seems like it's a headline company. So the night I said, but I did a study on it, and I posted it, and the night I did it, the next morning it was in the news, and it was down 3%. That was yesterday, and then it recovered and closed green, which was insane. So I said, this is a headline stock. I don't like to sell spreads in headline stocks because as a credit spreader, I want nothing to happen. That's when I make my money. I open the spread, nothing happens, it expires worthless, I keep my money. So play it safe, take less, stay out of the money. Selling puts instead of buying calls. I don't like to sell puts naked because it requires so much margin. I have a friend of mine who does that, but he goes, for 15 cents, and he goes ridiculously low levels. But it's still unlimited risk when you sell a, very big risk. Yeah, indices are good to trade because a lot of them trade $1 wide, like the SPY. Avoid the SPX because there's an extra fee of 60 cents, so you end up paying hundreds of dollars just to trade the SPX. Trade the SPY. And if you trade the SPX, try the SPX PM because it's evening. It doesn't settle on. It's not AM settled. Dead ducks on iron condors. If you don't watch them carefully, yeah, they can really bite you. You're not watching them carefully. You have to be disciplined at taking the loss. Don't be scared to take the loss. Let me see what other before I start delving. Okay, last words. I guess we can do that. You can get a. That's just garbage. Let's get to the meat. Anyway, so let's answer some of your questions here. I also trade ES futures, beautiful instrument. What else do we have? Nothing beats boring. Exactly. Who said that? Ted. I love you, Ted. Yeah, I want nothing to happen. That's when I'm happiest. I hate headlines. Draghi opens his boca, and I lose money. Yes, you can do the NDX. My last trade in the NDX was a loser. I bet against it. Thank you, Google. I'm not going to die now. Can you elaborate more on SPX PM? Yeah, it's just like SPX, except it's PM settled. SPX and RUT are AM settled. You cannot trade them on Friday of expiration. You can only trade them on closed or leave the position open on Thursday, but then you're just taking a chance because Friday morning is when they decide what's the closing price. So it's a gamble. You got to close it on Thursday. But if you go SPX PM, you can trade it on Friday. Mini options, they're now available. I haven't traded them. I've heard some mixed comments about them. Thinly traded, not sure. Do you put stop losses on? I don't put any automatic stop losses. You get spikes that absolutely ruin your, hey, I can see some new followers on Twitter. Love it. Listen, on Twitter, I post all day. If you want to know what's going on in the market, follow me on Twitter. You'll just get updates. And I have really good friends that follow me, so you can also see their updates too in my stream. What criteria, ETF trade? It all depends. I'm staying away from gold right now because it's so much of it, it's the GLD. I love trading it, but obviously gold is going up long term over decades, but it's controlled by few hands, and you can't gamble on that. It's a headline. Plus, with all the people printing money, can you see me? Can you see me? Or is not a good question regarding Apple? What was your question for Apple? I missed it. Oh, okay. Apple's Apple strategy. I love Apple as a company. I don't like their products. I know some of you are on Apple products right now. I'm an engineer, electrical engineer, so I tend to like to tinker around. Why is it 60 cents more on SPX? That's what they charge, not me. If you do a trade, you'll see it in your if you trade breakdown. Apple, long term, I'm bullish. Short term, people that know technical behavior, they expected to get down close to the 400. I called a bottom in Apple. I tweeted it and I posted it with Marketfy at 385-ish. I think I nailed it pretty well. If it gets down to 400, I'll be all in with credit spreads up to wazoo in the 350 area at about 50 cents. I'll put 100 down there. Can I use your service even as an amateur options? Yes, do it carefully and only follow the trades that I actually post in there in the portfolio, because I post trades that are for me more risky, but I only put the super slow trades in the portfolio. So follow me, and you know what? I don't have permission, but I'll give you all a 50% discount. Right now, I think it's 75 a month right now, but it's really nothing because you got a 30-day 100% money guarantee. So go ahead and do it. You will get write-ups from me every day, detailed with charts on everything. So even if you, well, I don't know how Options Express does it, because this is a fee that comes from the issuer of SPX. So look at your trades and you'll see extra fee in there. But if you don't, then great. How do I scan for spreads? I have about 24 stocks and tickers that I follow, and I add to them as I see some come, and I drop them out as I see some. Yeah, Apple will go down again. That's what the technicals say. So I just maintain a list, and somebody suggests a stock like the DDD. Now I'm going to start watching it. I don't do VIX. VIX is busted. Option House better. I have Option House. They have good quotes. I don't like their. You can't save a trade. Trade Monster lets you save a trade, so I can have a whole bunch of trades set up, saved. I can click on it and boom, launched. Netflix is a headline stock. I dumped it when I lost $1,000 on it overnight. I woke up and it was $35 lower. So I said, I can't do that. Too high for you? Tweet me. Sujata K. Okay? Tweet me. Racer Nick. No K. RACERNIC. How is VIX busted? Look at it. It's look at where the actual strike is, and look at the future price in the options chain. They're like dollars apart. I don't know what to do with that. What is my favorite spread? Credit put spreads on Apple and Google. How's TOS? TOS is fantastically strong. It's unbelievably strong. I don't know IB. To Gurley, you can always buy bull calls. Yeah, you can, but then you're spending money. I like my money now. Best broker, Trade Monster, for me. Yes, I do weekly options credit spreads. Not close though, really wide, small premiums. Right, please. Right, please. What? Oh, ach, war ich doch auf den Prismark. I don't speak German. Spell Twitter. Oh, RACER. Let me see. Can I do it? That's it. Racer Nick. I race cars. That's why I do that. RACERNIC. I'm also on StockTwits with the same handle, at Racer Nick or at StockTwits. You'll see my mugshot there too. I did it again. Why trade Monster over TOS? I use both almost equally. This is my handle. You're welcome, Eddie. I know I'm like one-eyed weasel right now. You do look like a professional race car driver. Oh my gosh, do I look like Dario? My wife says I look like Dario. That's pretty cheap, MBT, wow. Go to my Twitter. I don't have a website. I do have a blog, but I haven't contributed in a while. But I contribute a crap load on Marketfy. So sign up on Marketfy, and it's for 30 days. You can cancel, and you'll see my detailed pre-open and after the close and midday with charts, updates. I had a guy cancel on me the other day because he said I give him too much information. So sorry. I think his name was Tom. I'm not sure, but. What did you mean, Howlands? I don't know what that is. Yeah, charting on TOS is fantastic, Bill. I agree. I use technicals. Spell market what? Marketfy. Market. It's on the screen right now if you can see it. Let me see. Hold on for a second here. Let me do this for a second. Man, I love this interaction. I should do this every Saturday. Yeah, what's up with the German talk? I know a few cuss words. I'm not seeing Scheiße or Arschloch or whatever that is, so I'm happy. Yes, Marketfy. I didn't found it, but I asked the question and kind of like demystify, Marketfy type of a deal. They do great service. So the people that handle it are awesome. I don't work for them, but I work with them. Credit put spreads, yes, credit put spreads. I tend to lose more on credit call spreads when I bet against the company. What charting platform are you using? TOS, Thinkorswim. It's a TD Ameritrade product. They do great work. I mean, they update it. I just tried to launch it today, and it updated. I wish I can give you a screenshot. The charts in the background that you see are what I look at every day. So you can do all this kind of stuff. Ich bin ein Berliner. Yeah, we all know that one. Until you get a German girlfriend. My wife is married to a German girl. Come on, we got a minute going on. How are your TOS commissions? They're okay, but you got to take performance over price anytime. Options house bets, yeah, they are cheap, but like I said, they're a little. You know what? I tend to lose less in option house because I tend to be more conservative because I can't pull the trigger fast enough. So I tend to not take risky trades in there. Energy ETF, I stay away from energy because of the headline risk right now with Syria problems. As Syria gets out of the way, more talk of war between Iran and Israel, because Syria is the belly button that it's the conduit of weapons between Iran through Iraq into Syria through Lebanon for the Hezbollah, and Israel won't wage war against Iran with Hezbollah at its border while being supplied. Language typo. Yes, not my wife. My brother is married to a German girl. Yeah, it's a spread. That's funny. What are the numbers? So why are the numbers? Because I'm one-eyed. Are you offering discount? Yes, I'm offering discount. I don't have permission for it. I'm going to offer it right now. 50% off. Everybody. I don't care. First 200, I don't like that stuff. Why only the first 200? Just tell them Nick said so. Leave the Xian alone with you. No politics, I apologize. You're welcome, Trading Pub. Guten Tag. Ali, I don't know. Something nice, I think it's goodbye. Good presentation, I like your humor. 50% off of 75. Yes. And if you have an issue with that, Twitter me. I don't want the first buck to be a problem. Just get on board and see what you get. And you're risking nothing. They'll give you a full refund. You can't find my site? Marketfy.com. Click on that link. Okay, then go to marketfy.com. And then go to options, and then click on my picture, my product. It's called Create Income with Option Spreads. I think my time is up. They're going to kick me out. Am I still on? Is this thing on? Tick, tick, tick. So 50. Hit me on Twitter. I'll answer all your questions.
All right, good deal. Well, thank you, Nick. We appreciate you being here for sure. It was Nick's first time here at the Trading Pub. We'd love to have him back. So hopefully you guys enjoyed that and were able to learn about some of the options business. So again, you guys enjoyed that so far? Everybody enjoying the class? Want to make sure that you guys are having a good time. All right, good deal, good deal. So yeah, what we're going to do is just take about 30 minutes here. We'll do the last session for you diehards that are still with us. We started the day about 3.5 hours ago, and you guys are still tuning in for some good education about the market, so we appreciate you guys being here. I wanted to remind you as well, basically we've got next Thursday and Friday, we've got our Masters of the Market series coming up. That includes an intro class on Thursday night. Basically what we're going to do is do an intro class to help prepare you for the big day. We're going to cover 8 hours of advanced trading strategies with the experts. You'll hear from 2 hours from Tom, 2 hours from Hubert, 2 hours from Ross, and then 2 hours from Nick as well. Basically, the reason we're doing this is it's hard to fit in it's hard to fit in this much education in a short period of time. As you know, that Nick probably could have kept talking for a couple hours about some of those strategies, and same with the other guys. And also, it's very hard in a big crowd, with 800 people in the room, to kind of get all of your questions answered. And so what we've decided to do is take a class with each of them, and I really appreciate all these guys donating their time to this class, but you'll have 2 hours with each of them to spend learning more in depth about some of the details that they talked about today. Nick will be sharing professional options strategies from A to Z with you guys. Tom's going to cover live DAX trading and strategies for the cash open. Dustin and Ross are going to cover the Forex rundown for every level of trader. And then Hubert is he shared a couple of strategies today in trade setups. He's going to talk about 3 markets, his 3 favorite markets, and then he's going to talk about 3 trades that pay and share those with you. So again, if you want to sign up for that, we've had a great response so far, and you can just click on that link that I just posted there in the room. So thanks again to all of you guys